It's so great to see some familiar faces and welcome some new ones. As Alex said, for those of you I haven't met before, my name is Meghan Curran, and for the last 4 years, I've been leading Acumen's work in West Africa, where I've gotten pretty up close and personal with both the complexities and the simplicity of patient capital. As Alex mentioned, we've spent the last few months zooming back out to reflect on what 20 years of deploying patient capital has looked like. For those who are newer to Acumen, patient capital, what do we mean by that? And patient capital for us is philanthropically backed capital that is deployed to take high-risk investments in companies that can meet the needs of low-income customers. Grant capital comes into Acumen, goes out as equity investments, and the capital that's returned from those investments, rather than going back to investors, comes back to Acumen to be redeployed. So in 2001, we conceived of patient capital as a response to broken aid. We were in search of a third way, a solution that would bring rigor and accountability to development work and dignity and choice to low-income people. And in 2021, in many places where you used to find aid, you now find impact investors. Impact investors who've set out to solve a range of problems, but who often demand market rate returns. And so if back then we were motivated by finding a way to make philanthropy accountable to poor people, today we're motivated to find a way to make impact investing accountable to the problems it says it wants to solve. We see a lot of capital flowing to areas that are safe rather than to where it's most needed, with less accountability for impact and not quite enough honesty about where and why there are financial trade-offs in this work. I'm joined today by Acumen's President, Carlyle Singer, who will also talk more about how this work will shape our trajectory going forward. So, over the past 20 years, Acumen has deployed $132 million of patient capital in 147 companies. What's excluded from the 132 million are some of our early pure grant investments. These charts reflect our capital deployed by sector over time, which covers a very wide range of problems that our companies were trying to solve. But I want to start not with the impact story of Acumen, but the financial story. The story that tells us what you might expect to get back from a portfolio of companies tackling the most wicked problems of poverty in some of the toughest markets. Unpack what that math is, and also why it makes sense to us. So from 2001 to 2015, Acumen invested $100 million in 97 companies. We use this snapshot because we know that more recent investments, as I'm sure you can all appreciate, tend to perform better. But of the 100 million we've invested, 35 million has been repaid or exited, another 34 million has been written down or written off, and our shares have gained an expected $19 million in value. Taking that all together, we're looking at an expected multiple of 0.86x, or getting 86 cents back on the dollar. And some of you may wonder whether this is the right comparison. At Acumen, we've long debated whether we ought to compare ourselves to traditional investors using their metrics and measures of success, or to traditional philanthropy. But it's not really about who we're best compared to. The question we're always asking is, what will it take to change the way the world tackles poverty? And that's, for me, what's so exciting about this work, is that it's not about whether it's 86 cents or 82 cents or 90 cents, but that with a 20-year track record, we can say clearly and with evidence that to reach the most vulnerable in really difficult places, you can reasonably expect to get back more than nothing, but less than the dollar. There are 3 reasons, when we unpack this a little bit, that we believe that this is a realistic return expectation when tackling problems of poverty in emerging markets. The problems we choose to solve, that is where these companies are and who they serve, what happens along the way. You're not choosing impact once, you're choosing it over and over again in the life cycle of an investment. And finally, if, when, and how capital gets returned. And this is perhaps where we've had the steepest learning curve. So we choose to solve social problems in hard places. That means that customers have a very finite limit to what they can afford. The companies bear the expenses of weak physical and financial infrastructure. Companies have much greater exposure to disruptive shocks, whether it's a wildly fluctuating currency or political instability. They also face much harder to quantify challenges, like what it takes to find skilled talent, the need to vertically integrate across functions or deal with corruption. And even though each of these things are relatively known or understood, you may even have heard us talk about them over the last few years. Too often we see that these companies are still held to standards, whether it's the speed of growth or returns to investors, that ignore the material costs of these realities. And this is where we need more honesty about what it takes to build markets that serve the poor. Now, what happens along the way? There's so much focus on the companies that we choose and how capital's returned, but we're holding these companies for 7, 10, 12 years. And as we've learned, sometimes the hard way, the opportunities to double down on your commitment to impact are nearly endless. There's a structuring question, right, when you're setting up the transaction, and whether it's choosing a loan over a convertible note or a structured exit with a capped upside, where we have flexibility to optimize for impact. The second is increasing your financial exposure in really uncertain circumstances. When a company serving 100,000 customers is going to run out of cash in a few weeks, do you do that bridge loan? Some of you will join me in the Deal or No Deal session later today to find out. But finally, the cost of accompaniment, which is that along the way, the time, energy, and resources. Acumen averages between 6 to 8% of assets under management in costs, and a significant portion of that is dedicated to supporting these companies along the way. Now, these may be, on the surface, expected circumstances as an investor, especially companies hitting a cash crunch or a rough patch. But how Acumen shows up in these moments is one of the things that I've been most proud of over the last few years. And it's really one of the great gifts of philanthropically backed capital, where optimizing for impact gives you the freedom to do what's needed to ensure that that impact sustains. Finally, the if, when, and how of realizing returns. Over the last 20 years, the impact investing sector, including Acumen, has organized itself loosely around a venture capital model that relies on a few assumptions that don't always hold up in our work. This slide shows realized multiple per company in orange and expected multiples in blue. And there are two takeaways. First, a VC model assumes that a few outsized financial wins will balance the rest of the portfolio. But of Acumen's top 20 most profitable companies, the aggregate return is 2.2x. There's not a 10x in the mix or a 40x. It means our winners don't compensate for our losses. Second, a VC model assumes that you're investing in a liquid capital market where other investors are willing to pay for your wins and your successes. In our case, fully 70% of our returns are expected returns. And a lot can happen between expected and realized. The reality is that there isn't always someone willing to pay for those wins, partially because of the risks and complexities that I highlighted earlier, partially because not all investors want to serve poor customers. And so for even our winners, exiting is tough. That doesn't mean we won't still deploy capital using this frame. It just means we have to be clear-eyed about how to structure things and what the results might be. So that's the math conceptually. We expect to lose about 14 cents on every dollar we invest, and we're proud of it. And we're proud of it because of what we get and what the world gets in return. So let's look back at what we're getting through that lens. Through the course of its history, Acumen has impacted nearly 400 million lives, and conservatively, about 150 million of those are individuals living below the poverty line. But we also know this $400 million number kind of drives us crazy. It's wholly incomplete as a metric. When we started, we were thinking about building new markets that would reach low-income customers. And the development of lean data and the creation of 60 decibels was a major leap forward for Acumen and for the sector to understand who those customers were and what the impact of these new markets had meant for them. And yet, as we look back, we know that our impact has gone beyond building new markets. We've also used patient capital to create blueprints for public goods, correct market inequities, and strengthen fragile economies. More work is needed to help us truly understand how we can measure that success in each of these, the layers between customer voice and changing systems. But if we touch first on building new markets, off-grid energy is perhaps our best known work, where we've helped spark a shift from expensive polluting kerosene and cheap donated goods to a robust solar-powered marketplace, a market that has product diversification, customer choice, and affordability. Since our first investment in D-Light in 2006, Acumen has invested in 27 off-grid energy companies. And today, when you look at the people around the world who are accessing electricity through off-grid solar, fully 30% of those people are being served by Acumen's companies. SANERGY, on the other hand, was a for-profit business that was going to solve urban sanitation in Kenya. Over time, we and the company realized that a pure for-profit model didn't work, but that with some long-term subsidies, grants, the company could recover some of its costs, provide a valued public good, and be sustainable. And this is one of our learning, an important learning. If we started out believing that social entrepreneurship alone could solve the sanitation problem in Kenya, through investments in companies like SANERGY have come to understand the power of hybrid models that have a market-based approach or component, but are complemented by philanthropy or government, and that sustainability doesn't always have to mean pure for-profit. Now, thanks to SANERGY, more than 150,000 people in Kenya have access to clean, safe toilets, and this is easily a bet we would take again. What we want the world to understand is that too often we're comfortable using government funding for sewers in rich neighborhoods, but uncomfortable using subsidies for waste services in poor neighborhoods. How do we move past this double standard and find possibility in the space between pure for-profits and pure nonprofits to enable us to deliver public goods? Beyond building new markets to deliver goods and services to low-income people, we also know that global markets systematically exclude and exploit the poor. We're also starting to learn what it takes to correct these inequities. For example, 53% of coffee farmers in Colombia don't earn enough to cover their costs of production. Azahar Coffee is daring to build a pricing policy based on what it actually costs farmers to produce that coffee, identifying buyers that are willing to pay 2 to 3 times the conventional price to ensure a living wage for their farmers. And now taking it a step further to figure out how to make that pricing policy a standard for the industry. That would be a market level correction of a long-standing, deeply entrenched inequity that we're thrilled to be a part of. And finally, strengthening fragile economies. After natural disasters or war, aid and charity are inarguably needed to get people and communities back on their feet. But there's also a role for investment capital in enabling longer-term self-sustaining rebuilding to take root. In 2010, northern Uganda had been torn by decades of conflict. We first provided a revolving loan facility to Gulu Agricultural Development Company, an agribusiness that provided farmers with training, inputs, and market access to produce organic cotton. The company now has 700 employees and has reached nearly 500,000 people. But they also taught skills, reestablished trust, and helped spark an economic transformation in this micro-region. High-risk bets in places like Gulu have some of the greatest potential for deep transformational impact and are also the places you are unlikely to find more commercially oriented investors. With that, I'll hand it over to Carlyle.
Thank you, Megan. So in all this work, what are we taking forward in how we're looking at using patient capital in the next 10 years of Acumen? So first and foremost, investing as a means, not an end. A bold statement in our manifesto that is actually at the foundation of all the work that we do with patient capital. One of the biggest takeaways, and you heard Megan talk about structuring, is to actually free patient capital from what is a binary relationship, a limitation. Grants, zero return on your money, or any investment vehicle with the aspiration of greater than 1 return on your money. There's a lot of space in between, and we want to focus on creative ways to use patient capital that actually, again, to use a phrase Meghan was using, optimizes on our impact. You'll hear Jacqueline talk about a new negative interest debt facility that we're in the middle of structuring to take some of our energy work going forward. There is much creativity, we believe, in how we use patient capital, again, always thinking about how to incentivize and push towards creating the most impact possible. You also heard Meghan talk about impact measurement. We've always held ourselves accountable to measuring if we were having impact. And yes, lean data, now operating under 60 decibels, was a huge step forward. Hearing the customer voice, understanding the poverty level we were addressing, and probably most importantly, what was the qualitative change that a product or service was making in any given household. But we do have to take it to the next level. We do, if we want to solve problems of poverty, we have to understand whether we are on track doing that. These bigger areas where we know we make a difference, we create markets, we disrupt or change existing markets, or we start to build fragile economic systems. How do we know we're on the track? What are the metrics we need to put in place at the beginning to measure that and apply data behind it so that we can actually say to the more public world, this is what we know creates impact. This is actually how you do it. Here's the data that proves it. And then finally, we need to shift from a mentality that looks at an individual transaction and the impact it is going to make to a transaction in the context of a given problem we are trying to solve. If you go back to the chart that Meghan showed you on all the transactions that we've done in the multiple sectors, we need to narrow our focus, understand and take on certain problems, and then actually understand at each level, at the individual company level, at the sector level, what will it take to solve the problem. It will require us to work in much greater collaboration with partners in the for-profit and the public sector to bring greater resources together such that we can solve a problem. Just to summarize, 20 years ago, Acumen and a handful of other organizations are credited with introducing this concept of impact investing, which today is an asset class that actually has a wide range of financial and impact return expectations. Having taken the time to look back over 20 years of our work, we now know and can show you what this patient capital model looks like, and most importantly, the power it has to create change. Patient capital is an alternative use of philanthropy. It harnesses market forces to take on some of the most pressing problems of poverty in contexts that are extremely difficult. And when it succeeds, either at the individual company level or a group of company levels, the impact grows year over year over year. In a world that is facing a climate crisis that puts our very existence into question, and which we already know today disproportionately impacts the poor, we know we have a lot of work to do, and we need more patient capital to do it. Thank you for believing in this model through all these years. It's given us the ability to take big, bold bets to innovate for long-term social change. We are really grateful for your support. Hopeful about the work we can do in the future.